Is now time to panic as traders and investors. Over the last 24 hours, we got some of the craziest sentiment reports we've ever seen. Tariffs, dark pools, Wall Street's biggest moves, and the options market are just some of the things we'll be covering in today's video. But it also could come back to market structure. With Nvidia coming back to the most traded zone, the S&P 500 losing key support, and one of the biggest leads in the market starting to look incredibly dicey, is this start of something much, much bigger. Join us as we cover everything to do with markets right now. Well, welcome back everybody to the Daily Show, and a bit of a sea of red when it comes to the big tech stocks around the world. Nvidia absolutely got thrashed after what was a pretty good earnings report, and the market sold semiconductors all day after a rally in the morning. So what exactly is going on? Well, in today's video, we'll cover the latest macro, the data, and of course the key levels that you need to be watching as traders and investors. But let's get started with one of the craziest reports I think any of us have ever seen. We've dropped around 3 to 4% in the markets, but look at this. We are at 60.6% of respondents actually turning bearish. And this is telling us that the news and at least the information that everyone's getting right now is freaking everybody out. We are now nearing, get this, levels that we have not seen since early 2009. And this is off around 150 to 200 point move. Unheard of numbers. We're also at the worst level since September of 2022, which was literally after the market sold basically 20% off. So what exactly gives? Well, it tells you a little bit about what we've been discussing in this year. Basically, 2025 is going to be the market of no emotion. You can't be letting yourself get incredibly fearful or letting yourself get incredibly greedy. And it's why we're saying we need to have one step out the door. Remember, we just had 2 years of back-to-back 20% gains, and that usually means that this year is up, down, and all around. Leverage? Don't even think about it. What about markets? Be nimble and fast, and of course, potentially look at defensive sectors, and we'll talk more about those as we go through today's video. But what traditionally happens when we see reads this insane? Well, as you can see here, the latest data from Subu Trade actually tends to be pretty positive when you go past around the next 1 to 2 weeks. So could it get worse before it gets better? Well, the stats show that that's certainly possible. But when you're taking a look at the next month, 2 months, 3 months later, there's a good chance that we might get tax cuts, we may get deregulation, and some of those positive signs may come through. So at least on the surface of it, the sentiment report can be looked at as a contrarian indicator. People are seriously bearish. But what about the fear and strength models? Here's one from Grant Hawkridge, and you can see here that in general, it looks like we're starting to go more into that fear line. Does that mean the markets can't climb the wall of worry? No, they've definitely done that several times before, and that's why ultimately some of the key levels that we'll be looking at in today's video together will be so important to hold. Specifically, I'm just going to say it right now, 5,700 on the S&P. If we drop that level, big things could occur, and it really could tell us that every rip is going to be met by sell demand, and this is going to be a big level moving forward that we have to be paying attention to. But are there areas of safety inside of these markets? Well, first up, let's take a look at what happens when we see daily sentiment get to these highs. Again, traditionally, it's actually been a buy over the last couple of years, and we are now at the highest level of basically bad sentiment since October of 2022. Another read here just showing us that there is a significant fear being caused in the market, and people are seriously worried about what's going to happen in the future, and potentially rightfully so. So the question then, does it usually happen? Well, it kind of does. If you take a look at February's and the back end of February's in particular, we often do see sells. Now they can be exacerbated by first year presidential cycles. And as you may be aware of data that we've shared recently, this is the type of thing you tend to have. The second half of February is actually one of the worst parts of the year, whereas the first half of March is nowhere near as bad. So could things turn very quickly here? Yes, we may go down a little bit more. We may hit a few levels we'll look at in a moment, but traditionally there's usually a buy sometime around here if we are to follow the standard seasonal pattern. And of course, then it comes to, well, where are we going? Well, this is a chart that we had just a little while ago, and we were talking about how this year there is basically, at least according to the data since 1990, 100% chance that we were going to hit the 200-day moving average. Now, why is that? Well, as it turns out, whenever we've seen the 200-day moving average not be hit in the previous year, and we've been going up overall, we've hit it in the next year. 3 of 5 of those times it's happened in the first quarter. And of course, where are we right now? Well, we're in the first quarter. Where's the 200-day moving average? We'll look at it soon, but it actually lines up pretty well with a gap fill that could be there. So what exactly is happening? Well, the hottest market segment of 2023 and part of 2024 is getting hurt. Now, of course, Nvidia's earnings report is actually pretty good, and I think it lives up to expectations, but it doesn't matter what we think. The market obviously saw it as a buy the rumor, hit that gap fill, which was a great take profit. We did mention that together. And then, of course, sell it down, almost now to the most traded zone. So what happens in the next kind of couple of dollars for Nvidia is going to be a really big deal. But what you might also notice when you take a look at the last 5 days is some of the sectors we've been discussing in the market are actually holding their own, specifically healthcare. But what I want to discuss is this one, financials. Financials have actually not dropped now over a 5-day average. And one of the sayings in markets is that if financials are worrying and cracking in the market, you need to be a lot more scared of everything going on, because of course financials could be showing us that there is a significant debt problem, there is a significant crack in something in the bonds market, and that causes those flash giant sell-offs that are upwards of 20%, the ones you don't really want to be buying the dip in. What about a US recession? Well, of course, some of these signs here are also worrying, and it just shows you why 2025 is the year to be more careful. 2025, 2026, possibly the most dangerous years in terms of everything that we've seen since 22, and of course before that, probably the back end of 2019. Let's have a look at why. Well, a lot of it's got to do with bonds. We're seeing yields dropping through the floor. We're seeing treasuries now looking better than the S&P 500 from a forward return perspective. You can almost never say that. And the last times we had these types of things, you'll notice that it was around, of course, yield cutting periods. Now, when we saw so many yield inversions and then we started the cutting period, this tended to be a huge turning point for treasuries versus SPY. And it was basically risk on for treasuries and at least, sideways market or grinding market for the S&P 500. So it's time to look outside of the traditional when you're thinking about 2025, 2026 investing and trading. Why is that? Well, this chart probably demonstrates it the best. XLP, the staples market. Most people hate this market, and rightfully so. It's been pretty much trash for years. But just recently it started to turn up. At the same time, we've been talking a lot in our private community and also here, and you'll see why on the public show, where we've been discussing the idea that healthcare, staples, utilities may be starting to come in. And this is all a symptom generally of a late cycle market, which is actually increasing in terms of breadth into different sectors. So this year is more about sectors, more about asset allocation, as we've seen in China, as we've seen in gold, and as we've seen, of course, with European markets, than it is necessarily with just buying the index and saying all green, all good, let's just buy the dip and it all goes back up. We might see potentially weakness in some of the big tech stocks, and that could actually cause the market to go sideways and only barely grow when it comes to index returns, even though some sectors like healthcare are doing very well. Now, why could it be that healthcare is doing well? Well, insiders are buying it again, and traditionally when they've purchased this, they're not usually wrong when it comes to the next 2 months, 3 months, and 6 months. When we've seen insiders stacking positions, it's been an inflection point traditionally for healthcare. So that's something to keep in the back of your mind. Now, also, while we've been moving lower, and this is not true of the last 24 hours as much, we're actually seeing really just be a sell in concentrated areas, predominantly tech and predominantly anything that's high gamma. So anything that's been leading the market over the last couple of months has been getting thrashed, and that's been pushing down, of course, the S&P 500 and particularly the NASDAQ. But as you can see here, for at least a little period, we've actually seen more stocks moving higher. And this also bodes well when you start looking at 1 month relative returns, equal weight versus cap weights, when we've seen equal weight tech outperform its cap weight tech by at least 5% in a month. That's actually usually posted overall a positive return. So the issue is here is that we've got two storylines. One of the storylines is decent earnings. One of the storylines is, of course, an expansion in terms of the markets moving from possibly a mid-cycle into a later cycle, and there's plenty of opportunity. Goldman Sachs actually forecasting growth, and bonds markets, other than the last 24 hours, generally holding pretty well, although those are starting to get shakier, as we'll look at. The then question becomes the kind of randomness of this year. Tariffs, random geopolitical situations, and of course, potentially also unemployment on the spiking. These are all problems that could cause the US to go into a recession. And obviously, we need to look at things such as the potential Trump put, which could be literally the reduction in tariffs if the market cracks enough red and then ends up forcing some of those positions. So these are things that, of course, the market will be thinking about. And generally, you'll always have a positive and a negative case scenario. So the question you've got to ask is, how do you want to risk manage yourself? And this is a subject that we barely get to talk about because realistically, most people are bored by it. Well, generally speaking, when you're talking about your portfolio, your investments, your trades, any of these types of things, you've always got to think about risk management. If you go into a crypto or you go into a hypergrowth stock, then they have the potential of losing 40% in just a few days. Of course, something like a healthcare stock, if you buy in the whole sector, probably can't do that, although you never say never. So it's the same thing here with gold. As you can see, gold has been one of our favorite investments of the last 2 years, and we've been calling $3,000, which obviously we're incredibly close to, but you'll also notice here that gold is just getting rarer. So these are pretty good style investments if you're concerned about the geopolitical tensions, the tariffs, and everything else, and that's why it's been pretty good. Now let's go over to dark pools. What are Wall Street actually doing? Well, one of the biggest things they've been doing is it looks like they've got a huge amount of trades on 10-20 Treasury bond ETFs. The biggest, number one, the second largest, and the sixth largest over the last couple of years, just all printed at the same spot. Now, is this a buy or is this a sell? Traditionally, it's been kind of a sell when you're getting at these highs, but it also could be a buy here, and these are huge trades. So the reaction to the market around this point is going to be such a key. What a big chart for us to watch. Another one has been, of course, Tesla, which we did warn against up at the highs. Everyone was getting a little bit too feisty up here near $500. And you'll notice, as we did report on, huge amounts of transactions were just going everywhere up at the tops there. And of course, they were trying to get out. And hindsight's a beautiful thing. You can see it there clearly. But where we're starting to come down to are some interesting levels. We've seen it crash again in terms of breaking through and going down well underneath $300. Now, we do know that someone placed a large trade at $300. There was the 25th largest trade placed there. And what we'll be looking for is a cluster of large positions forming somewhere around the base. So stay tuned for that. I suspect we're going to get it on probably NVIDIA at some point. And we're also going to get it on something like Tesla right there. Let's have a look here at Gold Shares Trust. You'll notice that gold in general is getting a lot of transactions up here at the highs. That could be accumulation, could be distribution. As we've warned recently, although we're super bullish on gold and silver, you can see that it's kind of in a holding pattern. So when you go and take a look at the charts, these are kind of very important things to remember in the future. And if the market breaks to the upside, you can pretty much go, okay, they were buys. I've got the power of the dark pools, the power of the biggest traders in the world behind me, and it's probably going to keep pushing higher and smash through 3,000. If it breaks down, well, then you've got to look at that buy the dip. Where is the next level? So it may be time, if you're not in gold, just play the patience game. Patience, react, don't predict. Yeah, guys. So we're just looking at it. We're building the evidence. We're going with that. What about the flows for crypto? Well, obviously, crypto is seeing liquidations that are really high again. Not quite the extreme liquidations we saw the other day, but the sentiment around the crypto market's obviously terrible at this stage. Big breaks to the downside. We're going to need to see some more buys. I noticed there was a $2 billion bond from Metaplanet going out against Bitcoin again. So it looks like all these funds are still buying it. But in general, you'll notice here the outflows still very big on the delayed number of the 26. So we'll be looking for inflows to come back in before we get excited. Let's now take a look at the S&P 500. Not a good close. I mean, that's just not a good close. So it broke underneath 5,900. At the start of the day, we actually got back to around 6,000, which is where those kind of puts were. I would say some were closed, some were rebalanced, and then all of a sudden the market just kept going down and down and down. You can see here, we rallied, then we sold all the way into the close. Now, traditionally, if you sell into the close and you look that bad, you're usually going for some form of further sell-off in the next session. There are kind of some good signs though. The first good sign is that we came down and we almost gap filled. So technically the gap is here because of course the close is here, sitting at around 58.43. So we're getting close to that kind of key area. But as we've already mentioned, the market may need a little bit more because there are a couple of levels that we need to look at. The first one is going to be the value area low, which is basically a decent supportive area, which is just on 5,800. Now, this is a very key zone for the market to hold. But if it does fail here, I would say it meets up with this line down here, which is the 200. And what you generally want to be doing here is you want it to actually be a SMA, and you make it a 200. So we're going to do that right now. We'll do it together. 200, we're going to go 200 daily. And what you'll notice is it sits around that 5,700. Now, this is historically going to be hit this year. So is it going to happen now? I guess it seems like it could. And of course, first quarter was 3 of 5 last time. So this could be a pretty good level for bulls. And around this area is where I would suspect the biggest buyers will be there. Now, what we'll update with you guys, make sure to subscribe for this, is the dark pool. I think there'll be going to be some dark pool transactions. If we're going to go bullish again, dark pool has to step in here, because if we lose this position here, then as you may have seen alluded to, the problem is, and you'll see this on the bear side every time, is that, yeah, we may have a Wyckoff on our hands, some form of buying climax, UT, and then UTAD. And what this looks like right now is potential distribution. And it also makes sense when you have a look and you see all of the huge transactions that have been going through. Another thing that's kind of worrying when you take a look at this chart, and definitely this is why you've got to be a little bit less levered in the markets right now, is take a look at this volume profile. So basically what it's showing you is more transactions are going through at the highs than the lows. And that's disturbing in itself, because it suggests that there's more selling going on than there is buying at the bottom. Now, I love using this, and of course we use this in our course. We go through volume profile, we go through all this stuff, and a lot of you may think I don't use it, but I absolutely do to do the analysis, because it's such a good tool. And as you can see here, whenever I see those cells up at the top and I see more of a profile up there, I always start to question, is this actually a distribution? And of course that makes me cautious, which is why we've been talking about defensives as well, along with our cycle analysis and other things. So in general, of course, we've got a sideways market here, and you can see that it's coming down into some key levels, gap fills, all sorts of things. What does the options market though tell us now that it's had a chance to move? Well, the last 24 hours was big wild movements. 59.50s all got closed. We moved down to 58.50s now, as you can see here over the next 24 hours. And as we go into next week, 58.50 is now the most struck level, but we've also got 57s and 58s. So we've got quite a lot. Now, if we scroll to the next level, which is the 21st of March, this is the OPEX for March, you'll notice that we're getting a ton of 5900s, and we're getting a ton of 58s, and also 57s. So all of these three levels could hold the key. We've seen absolutely no structure buying yet. So as day traders, as swing traders, it's pretty much impossible to buy the dip. As someone that's position basing, you haven't even seen a big dark pool. So again, not really the best time to buy the dip until we see some form of structural creation. Now let's have a look here at NVIDIA. What have we got going on? 120 is hit. So as we mentioned in our previous video, 120 was the biggest put level. We've come down and smacked smack into that level. 120 has been hit. Generally, I would suspect around these next few dollars, we would get a large transaction starting to come in if there were buyers there. So that'll be something we're watching. And of course, when it comes to Tesla, you can see here we're trading at 280, which is the most struck put level. Now, if that gives up, where to next? Could it be 220? Is 220 going to be an insane level? I would say it would be, and a lot of people say, well, that's impossible, but you've got to remember there's a lot going on right now. The news is negative on this. Obviously, some of the sentiment and actual real fundamentals are starting to look worse. And of course, markets can do things that are pretty wild. So we could be going literally from 490 only a few weeks ago all the way down to 220. We've got to watch 280 and 220 on the charts. We'll show you guys how in just a moment. All right, let's jump into the leads. So first up, defensives, they're doing really well. XLP is doing really well. Obviously, my favorite defensive, healthcare at the moment, bounced down a little bit, but overall still holding incredibly well versus the SPY. It was actually up on the session. Bit of a nasty candle here though, so we can set an alert for above 149 if that happens. Could be a really big move here in healthcare. And in general, yes, it has become a defensive style market. I want to look at ITB though, because home construction is really barely holding on. This had one of the largest transactions, well, was the largest transaction. It was actually XHB, but same kind of thing. And we had the largest transaction ever recorded on the ETF right at the high. Now that tells me that someone was like, you know what, that's it, that's done. And this is often a pretty good growth engine for the market. So to be dropping this is an early warning sign of potentially bigger things to come, and certainly a worrying thing that you need to be putting in the back of your mind, even if we do rally to new highs. And of course, if it was not for the tariffs, if it was not for some of the things that are going through right now, it could be possible that the market may still be actually feeling pretty good. Pretty good earnings, deregulation, and of course, tax cuts. Those things generally do drive the market higher, and it's just all sorts of things, plus manipulation from the street, I'm sure. US 10-year continues to kind of drop through, which obviously is good for treasury-based positions. And as you can see here, treasuries have been probably one of the better holds of this week in terms of just generally holding up when everything else has been selling off. It looks like that may be set to continue unless those dark pools are a bit of a warning sign. We will see in price action soon. What's the US dollar doing? It's finding a little bit of buy pressure around this level. We still think the dollar should fall off, but the tariff concerns have brought the dollar back up over the last 24 hours. Gold sold off, getting close to kind of the first buy zone for some gold bulls, 2850 area. Will be interesting to see how it kind of sets up. Silver has not been able to find buying pressure again at the 31.20 level, which does expose 30.20 in general. I'd be looking for 32. If 32 plus break, could be a great sign that silver's really ready to go back up. Oil did find buyers at that day trade buy level that we spoke about yesterday, but look, oil is such a tough trade. It's still making a series of lower highs and lower lows, and only very small time frame kind of went bullish, and even then it's pretty much at this TP. So be careful here on oil. It may have hit bottom, but we don't know that yet. 281, 280 on Tesla, which is a put support. We don't really start to get into beautiful support areas though till around 250 and 220. Those levels there look really, really good. This is where I'd pretty much be looking at Tesla for the buy end. Here, it's okay, but it's not, closed on its low, so it's not really the kind of key level. So we're getting closer to a really significant pullback zone, which may be oversold completely. Nvidia sold off 120, which is where the puts are. Most traded zone is around 117, 118. We loved that last time. I suspect it's going to be defended again, but this just shows you why you've got to be so nimble in these markets. Beautiful run into earnings, sells off just before, hits that gap fill that we talked about, hits the positive gamma core wall, and then, all the way back down, up, down, and all around style market this year in 2025. Be nimble, guys, as much as we can. Semiconductors, frankly, terrible chart. Just terrible. That is terrible. Like, it closed below the lows. That is not a great chart. So you do not want to be looking at that and saying, wow, that's really bullish, because that is a pretty big close on the lows there in the semis, and it certainly is a concern. We'll have to keep watching. It's another bit of a warning sign. Even though the market's actually holding quite high, these are things we just didn't see in the same way in 2024 or 2023. So definitely tougher there. Chinese market still looks really good overall, still looking for 25,000, and pullbacks probably being met by bull demand. And US 2K dropped the low, which probably means that it may be going for like 2100. So at this stage, we'd have to look at US 2K to potentially 2100, 2080, and then maybe find some buyers. But there's nothing here to tell us that we should be a buyer right now. And that seems to be across the board. NASDAQ's kind of similar. Looks like it could go lower before it goes higher. Maybe down into the 20,400s even, or 20,000. Actually, where's that? 20,000. No, sorry, 20,000, not 20,400. So around 20,000, 20,200 would be the kind of level we would be looking at. So at this stage, there's just no bid. We need bid. And if we don't get bid, we're just looking at further selling. Same thing on Ethereum. No bid. There's no bid in the crypto world right now. If we go over here to Bitcoin, there's barely any bid. I mean, even in crypto in Bitcoin, it kind of came up and then just instantly got sold off. So we have to look at the structure. We have to break some of these series of lower highs. We just haven't seen that yet. And of course, if Bitcoin does want to keep falling, where could it go? Well, it could go all the way back down to 69,000. It is possible. So we must find bid. and we'll be looking for that together over the next week. As always, guys, there's always news. Core PCE is the big one here, price index coming out. And as we know, if that is a sign maybe for the Fed to look good, then maybe the market can bounce off that. That's at 8:30 a.m. New York time on Friday. In general, Fridays have been pretty negative when you take a look at the year so far. Hopefully we can buck that trend and we can actually find a buyer. I wouldn't mind it right now, based on what we're doing, to actually go and just hit the daily 200. Because if we do that, then at least we've completed the stat that we know was, well, basically 100% likely based on the 1990s. Again, nothing's 100% because, every time is different using historical studies. But at least if that happens, it opens up the case of, okay, that's out of the way. We still do have some bull case scenarios. Would I like the market to go up a little bit more? It really doesn't matter too much to me, but obviously for you guys, I think the thing here is that we would be liking to see the completion. So what that usually would mean is we would complete the general average statistic of a 2 to 3 year bull market from 2022, and that would usually take us somewhere to around 6850, 6800. Now, if we can do that, all good, but I will tell you this, margin has never been more dangerous. And that's one of my biggest reads, and that's why, for me, I've said it a few times in our private community, I'll say it here, I'm no longer investing in the market. So instead what I'm doing is holding certain positions and building just basically swing bases and day trade bases. It is a dangerous year. You've got to look at it as defensive side, and so far, I guess we've been right on that one. Defensives have been one of the best positions, and of course looking outside the US market. Thanks so much, guys. Thank you for watching. Subscribe if you enjoyed the content. We'll see you in the next one. And good luck. Remember, risk management, that's going to be the key to the rest of this year. Bye for now.